it seems like the investor community has been a tough one to please all year, Karen, because year to date, before today, Credit Suisse shares were down about 9% in line with the broader financial sector in Europe. Financials have not been a loved sector. Well, they were at the beginning of the year, but obviously fell out of favor in the last couple of months. But let's talk about Credit Suisse specifically, because the numbers that came out today were very strong, both on top line, on revenue, and on bottom line as well. Net income attributable to shareholders is up 114% from a year ago. So it's doubled. Net income has doubled from where it was 1 year ago. And that is, again, on back of the transformation plan that they have been doing away from investment banking towards wealth management. It's beginning to show signs of success there. Net new money continues to flow into that space, and at a decent growth rate of about 6%. Also, their funding costs continue to come down. Their operating leverage is positive. Revenues are up 7%. Costs continue to go down to the tune of 5%. So they're continuing to make revenues even though costs are going down. So overall, it is a good story. And I sat down with Mr. Thiam a short while ago, and I said to him, look, you've had a couple of quarters now, very strong, solid growth in your wealth management business. You're delivering on what you promised, but your stock is still down 9%. Surely that's frustrating for you. Let's take a listen.
All these things we're talking about go for a tangible book value. The SRU and its predecessors have lost us 7.1 billion Swiss francs. Right? The fines and litigation, another 3 billion. You're at 10. The restructuring, 1.7. You're basically at 12. The DTA, 2. You're basically at 14. And all kinds of other little things, another billion. So you've got 15 billion that I had to spend to clean up the legacy. That all came out of a tangible book value. That actually take your share price up to about, plus the capital raise, to about 11, if you do the maths. We're at 15 point something, because we've created 12 billion of profit since then. It's very important to understand that journey. You can't just take a share price. A share price is representative of a tangible book value. We had all these enormous problems to solve with very large numbers attached. There is no way that can be dealt with without driving the tangible book value per share down. Now, tangible book value per share is up. That's what's going to drive the share price and the re-rating. Because when the tangible book value per share goes up, your share price goes up. And then you re-rate. So I can tell you in the last 6 months, every one of the top 20 shareholders has bought. That's my indicator. Every single one has increased its exposure. The share price in the short term. There is absolutely no point comparing the share price before we dealt with all these legacy issues to the share price now.
That was Mr. Thiam talking about the share price and the lack of love for the share price this year. And he said it all boils down to the tangible book value per share. And of course, they had major issues to deal with, major headwinds that helped dilute that value, including 7 billion on the SRU units, about 3 billion Swiss francs in terms of fines, about 15 billion Swiss francs he cited in total. But now he's saying that a lot of those headwinds are out of the way, and going forward, he does see upside for that tangible book value per share. And I also thought it was interesting, Jeff, that he said that out of the top 20 stakeholders in the last 6 months, all of them have increased their ownership. So that tells you that at least some of the big hitter investors are beginning to buy into this story. So it's not surprising to me that today the Credit Suisse shares are up 3% in trading.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.